Hello, Facebook flippers, well, financial flippers. So today on our talk, we are going to be talking about taxes and finances, which is really exciting for all of us. You can feel free to drop some comments. I think you have to like approve or allow Facebook to comment through StreamYard. But our special guest today is going to be Miss Carly Crawford. Welcome, Carly. How you doing?
I'm doing all right. How are you?
I'm great. I'm great. So, how has this all been for you as a tax expert? Has it been busy? Uh, has it
Yeah,
been
been
slow?
very busy, which is a great problem to have. But uh, first of all, it's the never-ending tax season because the deadline got pushed to July.
Hmm,
It's awesome because it meant I could take on more clients, but
right.
also the economic impact payments caused a lot of confusion, and it also brought a lot of people out of the woodwork that haven't filed in years, who are like, "Oh crap, I need a stimulus check, and I can't get one if I don't file my taxes." Uh,
Right.
so it brought a lot of people out who were like, "Yeah, I've been meaning to do that for the last 5 years, but I never did." And also
Gotcha.
now they were sitting at home, a lot of people, and they were like stuck at home trying to come up with what they should do. So they were getting their affairs in order, which is great. So yes, it's been a very busy 3 months for me, for sure.
Well, I'm glad you're still busy. There's a lot of people in this group that are not busy right now, and so they probably have some of that confusion around those things. So if they have those questions when we're done chatting, then I hope they drop them so that we can answer those. But let's go ahead and dive into some of these questions. Or some of these topics that we want to cover today. So the first one is more talking about LLCing somebody. So what all that entails, and we have a lot of people who kind of own their own businesses, or they are their own businesses as performers or freelancers, independent contractors. So let's talk about LLCing yourself.
Yeah, so there's a few different pieces to this. A lot of people, especially when the 2018 Tax Cuts and Jobs Act, also known as Trump's tax law, went into place, a lot of people were like, "Oh crap, I have to LLC myself," because suddenly W-2 related expenses were no longer deductible in the way that they had been in the past. Um, and so a lot of people were like, "Well, if I LLC myself, then everything will be deductible." And the answer to that is kind of. So if you are a person who is, and these are primarily if you're in a union, is a lot of people who are getting W-2s but still have a lot of expenses. Um,
Mm-hmm.
so if you're unionized and you're getting a W-2, but you still have a lot of performing related expenses, for example, people were like, "Well, if I just LLC myself, then I can deduct all these expenses." And if you can convince your employer to pay your business and not pay you, sure, yes, you can. Um, if you
So
have,
if the check goes to you as a person, you can't write that off. It's better for them to write it to the LLC in that case.
yes, in most cases. Um,
Okay.
if you're a person who has a lot of mixed income, you have like a lot of 1099s, you have maybe one or two W-2s, you have some contracts that don't give you any forms at all because they're like $500 gigs, that kind of thing. Everything that's related to a 1099 or a self-reported income, so income you don't get a form for, as well as the sort of care and feeding of your business as a whole, like headshots or backstage.com or your website. Those things are all deductible, whether you're an LLC or not. Becoming an LLC as a single sole proprietor is pretty easy in most states. It's not super expensive. Depending on what state you're in, there are annual reports you have to file as an LLC that generally cost anywhere from $50 to $350 a year, depending on the state. Like I'm in Tennessee, and the annual report is $300 a year, which is a lot. In Illinois, the annual report is, I think, $75 a year.
Oh, it's a big difference.
It is a big difference. In Tennessee, there's no state income tax. So they're kind of spread, same with Florida. So they're kind of spreading things out a bit by making those things cost more. Whereas in Illinois, you're paying state income tax. So you have those fees that are a bit less. But you can LLC yourself. It's super easy. However, it may or may not do a whole lot for you. If a lot of people also were talking, let me rewind. Becoming an LLC is in a lot of ways a good legal move.
Gotcha.
Completely outside of taxation. It separates you as a human from you as a business, which is great if you are ever dealing with anything legal, especially if you are to become like a public figure, or if you're doing like sponsored content at all, and you need to get errors and omissions insurance, which a lot of people who do like partnerships with companies for media need that. Then it's a good idea to LLC yourself legally. It won't really make a difference on your taxes because a single member LLC and just a person with 1099 income are taxed the exact same way. There's no difference at all.
Gotcha.
Yeah.
So if there's, oh, go ahead.
The big difference comes when people decide to form an LLC and be taxed as an S corporation, which is something that makes sense above a certain threshold. When you're getting 1099 income, you're paying a lot of self-employment tax, and people start to go, how can I avoid some of this because the self-employment tax is killing me? And the way to kind of do that is to become an S corporation, or just to be taxed as an S corporation. You don't have to legally be one to be taxed as one. And that means you'd pay yourself a salary, what the IRS calls a reasonable salary, which means it's kind of comparable to what someone would make if you hired them to do it for you. And then you can take owner draws on top of that. And while those owner draws are subject to income tax, they're not subject to self-employment tax. So you're saving some money in that case. But unless you're making at least $75,000 to $100,000 a year, it's probably really not worth it, because
you're talking about just the income that's the 1099 contractor income.
Yes, because otherwise you're having to pay to file the LLC, you're having to pay for the annual reports, you're having to pay to file business taxes in addition to your personal taxes. You're having to file quarterly business federal withholding taxes and withhold money from yourself, essentially. So there's just a lot more overhead that goes into it. So if you're making below that threshold, it's really not worth it for you in most cases.
And that threshold, you mentioned like the self-reported income. So say because some of the people that are in here are a lot of self-reported income, meaning that they do those one-off gigs and say they are less than the $600. So they're not reported on paperwork through that company, maybe not through a W-9 or something, but you as the person, as the person contracted, still reports that. Until you reach that 75,000, it's not really something to mess with. Maybe, so should they do anything in terms of establishing themselves as a particular taxable entity, or should they just go ahead and stay as a sole proprietor essentially?
Yeah, that's sort of more of the legal question of should I become an LLC or not.
Sure.
In terms of taxation, it makes no difference.
Right.
The only difference is I have an LLC for my tax business, and I just put my LLC's name on my Schedule C and my LLC's EIN on my Schedule C, along with my name and my social security number. And that's the only difference.
Gotcha. Well, I hope that people are listening to that, because I do get that question often about whether or not people should go should I register as an LLC or as an S corp? And I know it's a much more complicated question, but I think you painted a really great picture of just kind of overviewing of why that threshold is there. But with all those people that have those kind of side incomes, let's talk about tracking that those expenses. So yeah, I'll let you just kind of go for it.
Please track your expenses from a tax preparer. Please track them.
You don't want just a tub of receipts just set in your lap?
I don't. I mean,
has it happened?
Oh yeah. I have many clients who do that, and that's sort of a different story. But I'm willing to do it, but it costs them a lot more money because I charge hourly. So if I have to go through your tub of receipts, like that's going to take a lot of time. But please track your expenses. There are a number of different ways to track them. You can track them in an Excel sheet or like a Google sheet so you can access it from anywhere. If I have clients who are really good at doing that, and if you are a person who knows, like, I'm going to sit down at the end of each week or the end of each month and I'm going to go through my bank statement and I'm going to put it all on there, then that's fine. You don't need anything fancier than that. If you can keep up with it, that's fine. If you're a person who's going to forget about it for basically the whole year, and then you're going to get to the end of the year and you're going to be like, oh crap. Or if you have something that's a little more complicated, or if you are looking to eventually become an S corporation, or if you're thinking about talking to investors for any reason, then you want some more like concrete books. And there are services that do that. Obviously, QuickBooks is one of the best known ones. QuickBooks is good because it's good at what it does. There is a QuickBooks Self-Employed. I don't love QuickBooks Self-Employed because if your business grows, it is hard to transfer Self-Employed into the other versions of QuickBooks. But the most basic regular QuickBooks, I think, is called Simple Start. And that one is great and is much easier if your business grows to expand into the more advanced levels of QuickBooks. There's also a free service called Wave, which is similar to QuickBooks, and you can send invoices and things like that, and track income and expenses there.
They just announced today that they're integrating bookkeeping and banking into their platform.
Oh, great.
Yeah, so they're trying to make it more all-encompassing, I think, similar to not only can we accept payments, but we'll be able to track and help you organize everything. Now, this is a kind of random question. In terms of organizing those expenses, we use QuickBooks, so it's really easy, and there's so many different categories, but there's almost an overwhelming amount of categories. So for somebody who just is doing it on their own and not using any kind of a service, what are there like main staple categories, or can you divvy those out?
Yeah.
Should you divvy those out?
There are. The thing about the categories, and I was talking to a client about this today, is technically, I guess you don't have to put them in categories. You could just put them all as expenses, but that's going to look really weird to the IRS. If you have like $5,000 in miscellaneous expenses and no other expenses, they're going to be like, you were not paying attention. What were you doing? Even though they kind of are taxed the same way, or they're deducted in the same way.
Sure, but on the taxes, they all go into different categories.
Yes, exactly. So there's advertising is a big one, especially for artist types. Advertising would be things like your headshots, your website, your print. Well, no, not printing. Your, I guess headshots and websites are your big advertising things. Then there's commissions. So if you have to pay your agent out of pocket, like if you get the full check and then you have to give them their percentage, your commissions. Contract labor is a big one. So if you're hiring someone to help you, if you're hiring an accompanist, if you're hiring a videographer, all of those kinds of things. Legal and professional fees is kind of a weird kind of catch-all if you have to pay for anything legally. If you were LLCing yourself, that's where you would put the like LLC fee. Is in the legal and professional fees. Accounting is one. So if you pay for a tax preparer in 1 year, then the next year, that's a business expense for you. Uniforms, which is, that's a tricky one because a lot of people, performers especially, are like, everything's a uniform. I wore this to a play once.
Research and development, baby.
Right. I can write it off. I wore this to a play once. And you're like, that's pajamas. You can't write that off. That's not, no. The general rule is if you would wear it regularly, like in your regular life, if no one was telling you to wear it, it's really not deductible. If it's a costume, obviously, yes, it's deductible. If it's something that you have to wear because your agent was like, you're wearing red in your headshot and you're only allowed to wear red to auditions now for some bizarre reason, then sure, if you had to buy something red, deduct it. When we get into those gray areas, particularly with artists, because everything is a gray area, I try and just tell people to be judicious about what they're doing. Don't deduct every single thing that you've purchased in a year. You know that's not a business expense. Like that's, you know it's not.
Right. And we'll talk a little bit more about some of those like business expenses versus itemized deductions a little bit later.
Yeah, and another big category, especially for artists, is education. And the thing about education is that education is deductible if it is helping you to do the same job that you are already doing. So
a lot of people are taking online classes right now. So say they paid for an online class to take digital marketing or something like that, or maybe something that wasn't related to, say, performing, but they're taking a course on that.
It is not. It would have to be related to the work that they were already doing. So if I'm taking an acting class, if I'm paying a monologue coach, that's deductible. If I decide that I also want to be a yoga teacher and I sign up for a 200-hour yoga teacher training, that is not deductible because that has absolutely nothing to do with my acting. Now, if they've let me teach yoga classes while I was still getting my certification and I have income from that, then that's a different business and then we can talk. But
gotcha.
You can't deduct your yoga teacher training from your acting income as a business expense.
Not the same. Awesome. Those are great categories to kind of give people. So let's head into just the idea of all of this miscellaneous income that's coming in, and we're trying to organize it. We're trying to track it. We're putting it into these categories. But a lot of, and this is something that I run into working with people too, is that their money, they get the money, so they get the check for the $500 gig that they've done, and then they just pocket all of the money and use all of the money, as opposed to remembering that that's income, so you're going to have to pay taxes on that income. And me and Ashley, we set aside 30%. We've heard 20%, 25. 25 is probably most common what we hear, but I don't know if you have an opinion about what's safer or what's better or what's on average for you, or.
Yeah, I mean, more is always better.
Right.
Because at the end of the year, you're basically like giving yourself a tax refund if you don't owe it all. So yes, the minimum requirement is that you are going to owe 15.3% in self-employment taxes.
Listen to that, flippers, 15.3. That's the minimum.
That's the minimum. And yes, it is 15.3% of your profit, not of your gross income. And yes, I don't want you to say that I lied to you, so I'm going to tell you this number and then you're going to let it fly out of your head. It's actually 15.3% of 92.35% of your profit. I said it so that I didn't lie to you. Now forget it. Just 15.3% in your head. 15.3% represents your employee portion and the employer portion, because you're self-employed, of Social Security and Medicare. The concept is that one day when you are old enough to draw Social Security, you will receive that money back. I cannot speak to the existence of Social Security in however many years, but that's the idea. The idea is you're going to get it back eventually. So it's like the government's like, you have to save this. So that's
get some of it back.
Yeah, you'll get some.
Maybe.
That is the minimum. On top of that, you're paying income tax. Then, of course, you're not paying income tax on all of it. You're paying, you have a deduction, whether it's a standard deduction or an itemized deduction. There's potential credits that you could have and all of that, which is why people say 25 to 30%. 25% is usually what I tell people, just because people panic if you tell them 30%. So I say 25% to start. And then when they still owe a little bit of money in taxes, I'm like, remember that. Now we can say 30, and then this won't keep happening.
Right. What Ashley and I do is we set it off to the side in a online savings account, which at least earns a little bit more interest while it sits there, and just, while we save that 30%, because I would rather be in charge of that than the government.
Yes.
To do that. So speaking of the government needing their money, which is what you do, let's talk a little bit about quarterly payments.
Yeah, let's talk about them. So quarterly payments should be paid if in any year you expect to owe $1,000 or more in taxes, and you're not having enough withheld from a W-2 job. If you're working a full-time W-2 job and then you're doing like a show at night and you're making like $2,000 a year in 1099s, you probably don't need to worry about quarterly payments.
So is there like a threshold for how much you're making in addition to a W-2 job, perhaps?
There's not, because when you have a W-2 job and you complete your W-4 form, which tells your employer how much to withhold, there are 12,000 variables that can affect how much they withhold. So it's not like they're saying, here is your income and here's what we're withholding. It's like, here's your income, and you also said you were married, and you also said you had a kid, and you also said your husband has a job, and you also, so it's like, there's no way to give a specific number.
Super easy.
Yeah, but quarterly payments, basically, in order to avoid a penalty, you are looking throughout the year through a combination of withholding from W-2 jobs and quarterly estimated payments to pay 100% of your prior year's tax liability. If you make under $150,000 a year. If you make over that, it's 110%. The real rule is 100% of the prior year or 90% of this year, but no one I know who is an artist has any idea how much money they're going to make in a year, so that is a stupid thing to try and figure out, because it's not going to happen. So I just ignore that part. And to get the 100% of the prior year, you're not just looking at what you owed, you're looking at what your total tax liability is. It used to be line 37 on your 1040. It might not be line 37 anymore because they changed the form. But there's a line that says total tax. That's the number you're looking for.
And that's what you would divide into 4, and you would make those as quarterly payments.
Divide by 4, make those quarterly payments. If you're working a W-2 job and you expect, like, I'm going to make the same amount in 2020 as I did in 2019 from a W-2 job, then you can look at that total tax. You can look at what you had withheld and say, well, they're probably going to withhold the same amount. And then you can divide what's left by 4.
Right. Now, here's something to also think about. So 2 years ago, Ashley and I owed a lot more in our quarterly payments from the year prior's taxes. But then this year, we are paying quarterly payments that are just a fraction of that 30% 1099 income that we hold off to the side to save for taxes. So do you advise just sticking to the minimum quarterly payments, or do you advise doing what you were doing in the past, or do you change that, or do you just use that form? Because what happened with us is, and I don't know if other people are having this too, but they have a form that just prints out and it says, just through our taxes, what we did, this is what you owe, and do this quarterly.
Yeah, so it's up to you. If you are a person who can set aside your percentage into an account and leave it there and not touch it.
Don't touch it. Don't touch it.
Then paying the minimum in your quarterly taxes is fine. Because then if you need the money when it comes to be tax time, it's there. You've put it there. You've put it aside. But if you are a person who knows yourself and you know that you cannot not touch it, and that if it's there and you think, oh, my quarterly payments are only $500 a quarter, so now I can spend all this extra money I saved. No, please don't. Just pay higher quarterly taxes. In general, I don't tell people to pay higher quarterly taxes than necessary because you're just giving an interest-free loan to the government. And
Yep.
why would you give an interest-free loan to the government? They're not going to give you an interest-free loan.
No, we got very happy when we were able to hold on to more of that 30% that we put off to the side.
Yeah.
And we're like, oh, okay, yeah.
If you have good self-control, then just pay that minimum. Excuse me. If you are working on your self-control, then maybe pay it a little higher so that you don't feel scared when it comes to tax time. Because paying what the software says in quarterly taxes is not going to guarantee that you don't owe anything come tax
Correct.
time.
Because it's based off of last year's taxes.
Yeah, exactly.
So
it's not going to guarantee that you don't owe anything. It's going to guarantee that they don't smack you with a penalty on top of it.
Right. It's always better to be careful. I like your advice. If you're that person that knows that you can hold on to that money, then go ahead and keep it off to the side and go ahead and make a little bit of money off of that while you're waiting for the year. But if you're not, if you're going to spend it, go ahead and send it to the government because you know that it's owed anyway. And then when you deduct, then that would go away.
Yeah.
So
one more thing about quarterly payments is
sure.
I also tell people, if you are a person who can't handle quarters, like if quarters are just like crazy weird things that kind of don't exist in your world, you can pay monthly. You don't have to only make 4 quarterly payments. You just have to pay each quarter's amount by that quarter's deadline. But if it's easier for you to pay it like rent, you can pay it like rent. You can make extra quarterly payments. So
I'm sure the government won't mind.
They don't care as long as they get their money.
That's right.
So that is an option for you. Also, the other thing about quarterly payments right now is that tax deadline got extended to July 15th. They pushed the first quarter's payment to July 15th as well. And then for a long time, they didn't say anything about quarter two's payment, which is usually due June 15th. And now they have said, well, quarter 1 and 2 are due on July 15th now. So
gotcha.
That's great.
Makes your job super easy. Not complicated at all.
No, not difficult at all. And everyone.
I don't think any of us envy you.
Right. Well, and everyone just has 2 quarters of payment hanging out.
Right.
If they've put it in their savings account. But
if they've set it aside, yeah. All right, so let's move into claiming versus not claiming. We chatted just briefly about this initially, but money that comes into an independent contractor's life from all different walks of life. Sometimes there is no paperwork. Sometimes there is paperwork. I mean, I know even when I waited tables back in New York, I mean, it was the morality issue every day when you clocked out was, okay, well, how much of this do I claim, or do I claim it all? And I've got people telling me don't claim it all. I've got people telling me claim it all. So talk to us a little bit about claiming versus not claiming.
Yeah. I mean, I think I myself am the prime example of claiming versus not claiming. Because no one is giving me a 1099 for doing their taxes.
Right.
You know, no one, unless you are a business or I'm doing back taxes for you, is paying me $600 or more to do their taxes. So no one's giving me a 1099. The IRS knows that I'm a tax preparer. I can't just tell them I made no money as a tax preparer. They have my tax preparer ID number on 200. They know I didn't do that for free. If I don't claim that money, they're going to be like, excuse me. Like, what were you doing? And then they would not let me do taxes anymore. But so yes, and legally, as a preparer who is bound by ethics, I have to tell you, you have to claim your income. If you make $100 by showing up for a work day and they give you $100 in cash or write you a check and you never hear from them again, is the IRS ever going to find out about it? Probably not. But legally, yes, you have to claim that. And again, legally, the concept, especially when it comes to self-employment money, is that if the IRS doesn't know how much money you actually made, then when it's time for you to draw Social Security, they're not going to know how much you deserve.
So the more you claim now is going to absolutely affect your Social Security payout eventually.
Theoretically, yes. According to how Social Security is set up today, June 11th, 2020, yes. The amount.
So that's a really good bit of information to know, because I don't think a lot of people know that, well, if I just claim less, then I can keep more of my money now. I know some people, if they know they're going to have a really good week, they'll just stop paying taxes for that week. They'll like turn off their taxes to take more of that money home. But this is the first time I've heard it, that affects your Social Security payout in the long term. So if you're consistently doing that, then you're really doing yourself a disservice in the future.
Yeah. And yeah, so yes, legally you do have to claim it. I have some clients who are really good about it. I always ask clients 2 or 3 times, like, do you have any income that was not reported to you on a form? And I'm sure somebody somewhere has lied to me, but it's one of those things where it is a morality thing, right? You're like, but right. I want to keep my money, and also I don't have that much money, so I don't want to give you a lot of money when I could be using it to pay my student loans or, you know, whatever else.
Sure.
But it is something to get in the habit of, because you don't want to start hiding money from the IRS. That is not a path.
The last thing you want is the IRS coming after you, right?
No. And if you are like genuine, they know in good faith. Like, you shouldn't be afraid that they're going to come knock on your door and be like, you forgot that someone gave you $50 once. That's not going to happen. But if you create a pattern and it's a recognizable pattern, then maybe.
Right. But then not only the morality, just I think that's such a nugget that I just want to keep repeating, that it'll affect you long term. These choices that we make for the short term game, we talk about that sometimes in the Flippers group, just in general. Don't focus on just what is good right now for you. Let's focus on the long term game. Let's play the crock pot game, not just the microwave, right?
Yeah.
Because the quicker it is, the probably more flimsy and fragile that situation is.
Yeah.
So this is what we were talking about a little bit earlier when we were talking about the categories in terms of expenses and all of that. So let's talk a little bit now about the business expenses versus itemized deductions, which I know is something that you're passionate about as well.
Yeah, there was a lot, there still is, and there was, especially 2 years ago, a lot of confusion about the difference between business expenses and itemized deductions, because people heard the tax law is changing and you can't deduct anything anymore. And then everyone threw away their receipts. And I was like, please don't do that. No, you still want those. Please keep those. You still want those. So while it was true that W-2 job expenses were no longer deductible, like we said earlier, 1099 related expenses and expenses related to self-reported income are absolutely deductible. The difference between itemized deductions and business expenses is that business expenses directly reduce your self-employment profit. So if you make $10,000 in 1099s and you have $5,000 in legitimate business expenses, then you're only paying self-employment tax and income tax on $5,000 of that money.
Which is very beneficial. It can be very beneficial to somebody to do that. But just for those listening, give an example of a business expense versus an itemized deduction.
Itemized deductions are things like charitable contributions, mortgage interest, property taxes, medical expenses to a certain extent, although medical expenses have to be above a certain threshold in order to be deductible, which is another, you know how earlier I was like, it's this much of this much of this much. Medical expenses are like that.
Oh man.
They're deductible to the extent to which they exceed 7.5% of your adjusted gross income. Yeah, it's stupid. Don't ask me why. It's a dumb equation. But itemized deductions are those things that you feel like when you were in college or when you were like 20, that your parents were like, when you buy a house, you'll get to deduct this off your taxes, which is true. So itemized deductions still exist, and they are still worth it for some people. However, you can either itemize deductions or take a standard deduction off of your adjusted gross income. So business expenses directly reflect what your adjusted gross income is by making your profit smaller. Itemized deductions then further make your taxable income smaller. So there used to be a standard deduction and what was called a personal exemption. So you got a standard deduction, and then you also got some more money off just for being a living, breathing human. And then if your household was you and another living, breathing human, then you got 2 personal exemptions and still just one standard deduction. And therefore, it was easier to make it worth it to itemize deductions because the itemized deduction itself was only between $6,000 and $6,500 depending on the year.
Right.
So if you had more than $6,500 in mortgage interest, property taxes, and charitable contributions, which in most places in the country, if you own a home, you do. Mm-hmm. It's easy to get above that. Then it was worth it to itemize deductions. But when the Jobs Act rolled around, they got rid of the personal exemption and they basically doubled the standard deduction. So they made that threshold a lot higher. They moved the goalposts really far. So
an even smaller amount of people now are itemizing their deductions.
Yes. And the concept was, it's going to be easier for people. They won't have to do all of this work and all of this. But everyone, specifically millennials who've been told our whole lives, when you buy a house, you get a huge tax break, aren't seeing that anymore because they can't reach that threshold. If you're married, it's double it. So if you're married and you're filing jointly, then your standard deduction now is $24,000. It's a lot harder to find $24,000 of itemized deductions. So it's not worth it for a lot of people. So I have a lot of clients being like, why isn't my mortgage interest helping me? Why aren't my property taxes helping me?
Which brings us to, I know one kind of thing that you wanted to make sure to mention to everybody before we finish this, using the mortgage insurance or buying the home as the example, that one kind of final note to people about finding tax preparers and doing that on their own.
Yeah, a lot of people, I think a lot of us who are young adults and young professionals have been getting our tax advice and hearing language about taxes from people who are in our parents' generation. And their advice is not necessarily wrong. It's just not applicable to the way that we live our lives today. 30 years ago, people got out of school, whether they went to college or just left with a high school diploma. They went to work, they got a job, and most of them stayed at that job for the next 30 years. That doesn't exist now. We don't do that. And we now have the gig economy, which is like a whole nother ball game. And so the tax advice that we were getting, while in good faith, no one's trying to pull the wool over your eyes or mess you up on purpose. It just doesn't fit. So if you're a person who knows that you have kind of a bizarre income situation, you may not want to go to an accountant's office where there's stuffy men in business suits who that only work with investment bankers. They're not going to understand what you mean when you're like, yeah, I had to buy this costume to do this thing. And yes, I want to write off part of my Netflix because I use it for research. And they're going to look at you like you have four heads.
It's super important to find somebody who understands your particular situation.
Yes, definitely. And someone
Is there a
afraid to refer you to someone else when they need to. I've been expanding my network, so I have you that I refer people to for financial advising. I have a lawyer that I refer people to when they need like business law advice. And it's nice to be like, I can't answer that question because it's really not my purview, but this person can.
Right. Which is why we're so thankful to have people like you able to come on and talk to us, to all of us, because we all have different specialties and different expertises, and to be able to share that with a collected group of people that are all trying to kind of, as you said, check all the boxes, but do it efficiently and do it responsibly and try to do it as best as they can. There's so many different nuances to all aspects of money, but especially when it comes to taxes. So you are a wealth of knowledge, and I can't tell you how much I appreciate your time. And I'm sure that a lot of people will have more questions. I mean, we got one comment that was somebody talking about the interest-free loans, and they thought that was funny from the government. But that's essentially what it is, right? I mean, if you're giving the government too much, they're sitting with that money for the year.
Yeah.
You're not going to get that back until you file your taxes. You know you're going to get that money back, so why give it to them now if you don't have to?
Right. And don't, oh my gosh, please don't ever just send the IRS money at a client who filed his taxes on his own and then realized he forgot that he had sold some cryptocurrency. And so he freaked out and he mailed the IRS a check for $2,000. And then he called me and was like, can you fix it? And I was like, yes. First of all, never just send them $2,000. Like, they'll send it back to you. If you send them money that doesn't belong to them, they will give it back, but it'll take a while. And also, don't do that. Please don't just give them that money for no reason.
No, never.
He didn't owe anywhere near that amount of money. And
he just got scared.
Yeah, he got scared. He was like, they're going to find out. They're going to put me in jail. Here's $2,000. And I was like, no, they're not going to put you in jail. They're going to send you a letter that says, hey, it looks like you didn't report this, but we have it reported from your bank that you sold this much whatever. So we think you owe this much more in taxes. Do you agree? Cool, send us the money. Do you disagree? Cool, tell us why. They're not going to go straight to like banging on your door and taking your car away from you.
You make the IRS sound like such lovely people. And I guess they're nicer to you than some other people.
Well, maybe that's true. But they will always send you a letter first.
It's because you report your income. That's why. Cool. Well, thank you so much, Carly. Everybody here knows that they can reach out with questions, and her information will be on the post. And we appreciate your time, and we appreciate everybody who's watching this video on replays and that. So thanks again.
Thanks for having me.
Yeah, you're welcome.